Testing. Okay. Okay, good evening, everyone. My name is Zach. So I'm working on the Forex, the capstone project. So today I will be talking about my project, and I will introduce some background information first. Then I'll talk about my approach, and I'll share some of my results with you. So first, foreign exchange market, also known as Forex. It's the largest financial market in the world. It has over $5 trillion volume trading per day. And there is approximately only 1% of them are retailers. So the other parties are big banks, super hedge funds, and other institutions. And it's traded 24 hours a day, 5 days a week continuously. And currencies are normally traded in pairs, such as euro dollar or pound dollar. So they can be treated just as stock names with its own price. And we're going to talk about how professional traders how they're going to trade, and my approach is to mimic their process. And normally the professional traders will use technical indicators, and there's no single rule that they will use. They will look at different indicators, and they will look at different rules. So such as the first signal, the confirmation signal, and they will look at volatility signals. It also takes years of practice to actually master the skill to make some profit in this area. And there's some key points to success in the foreign exchange market. And the first one is money management, which is to control the risk, to control the exposure to the market at any time. And another one is emotional control. So this is a good thing that machines could replace the traders in the future, maybe. So I've done some literature reviews. Someone made this beautiful chart summarizing all the historical research haven't been made in the recent area. So the majority of them are SVN and neural networks, which is like point-wise estimation, prediction. They use like deep learning networks to predict whether the price is going up or going down. And it's normally like a regression or classification problems. And some success has been shown in these areas. And another important part, which is very also popular, is evolutionary computing and fuzzy logic. They are such as genetic algorithm. Genetic algorithm mimics the natural selection process, and it is normally used for optimization problems. So researchers conducting this approach will maximize the returns on the portfolio instead of maximizing the accuracy or reducing the root mean squared error. So my approach will be taking the genetic algorithm to focus on the trading part of the model, and instead of focusing on maximizing the return, I will be maximizing the Sharpe ratio, where the Sharpe ratio is actually the return over the standard deviation, which is a proxy for the risk. So with higher risk, the lower the Sharpe ratio, but with lower risk, the higher the Sharpe ratio. And it also incorporates the return. As the higher the return, the higher the Sharpe ratio. So this is a very simple trade strategy. I will talk about this one. So this is like on the blue line, it's a close price of like a euro US dollar, and on the green line, it's a moving average of the previous 10 data. So on here, we can see on the first red dot on the left-hand side, that we can see the close price is going across the moving average, which indicates a strong trend going up. So that's the time we buy the stock, or not buy the Forex security. And what's the time to sell it? We'll wait for the next crossing happen, which is the green circle on the middle top. And that's the time we sell. And we not only sell at that time, we're also going the short position in this time. So we're going to hold the short position until the next cross, which is here. So for that simple strategy in this little time frame, how much profit are we making? So we're betting on it's going to go up. So it go up for that amount of the pips, and it also dropped by so much because we're going short. So we're also making that amount of profit. That's just a simple trading strategy using one technical indicator rules. So for the moving average, this one, I used the 10, but it could also be like other things. These are the parameters that need to be optimized. So I will introduce a overview workflow of my trading system. So I will extract the historical data first. Then with the defined technical indicators, I will combine them into trading rules. So not only one trading rule, I use 16 different trading rules. And because the search space is relatively small, so I will use a grid search method to optimize the parameters such as the moving average period. After this, I have 16 different rules defined. With the 16 different rules, at every time step, I have 16 different signals obtained from the trading rules. So with those signals, I'm trying to use a genetic algorithm to maximize what kind of weight am I supposed to put on this security. So with the genetic algorithm, I will have the optimal weights for different rules. So with these rules, I will combine the rules with the trading signals and test them on the test data set to see the performance of this. How well does it generalize? So the data I use here is a euro-dollar currency pair with 5-minute time frame. It contains 100,000 timestamps from April last year to September this year, so it's pretty close. I split them with 50% ratio. So the first 50% of the graph shown here, the blue line is the training data, and I'll test them on the orange part of it. So, okay, so technical indicators. There are 4 types of technical indicators. So they're trend, momentum, volatility, and volume. Volume is not used here because Forex is decentralized. Forex market is decentralized. The volume data we can have is only the amount of transaction happened at one broker. With so many brokers out there, it's impossible to get all the accurate data of the volume. And also considering the amount of the volume, trading volume on the Forex is huge. So we're not using the volume indicators. So we mainly use trend, momentum, and volatility. The trend means is whether it's going up or going down. Momentum sort of means the gradient of going up, how fast it's going up or how fast it's going down. Volatility refers to how fluctuation are the prices, how fluctuations are the trend. So combining those 3 kinds of technical indicators into the rules will give some sort of understanding of the current price trend. So the trading rules, there are 4 types of rules. So these rules are majorly crossover rules. There's the first type is just like the example I've talked before, which is a moving average with price, and also use some like exponential moving average with price. Yeah, these are just crossovers. Whether it's higher, whether it's lower, they will give different signals. Like 1 and -1 means buy or sell. And the second type of rules is using the threshold. A threshold means a level. If the time series data is higher than the threshold, it means we're buying. If it's lower, that means we're selling. And type 3 is with 2 thresholds, where when the time series in between, we don't buy or sell. So we just empty all our positions. We hold 0 positions at the time. So that's like a no trade signal. And fourth type is more like a volatility based. It's like a band thing, like Bollinger Band. There's an upper band and lower band. So these type of rules will be integrated. And after optimizing for the parameters for these kind of rules, we have 16 different rules. And this is like a sample output data frame with the optimized trading rules. So for every time period, there is a signal based on each rule. And we will combine these rules using genetic algorithm. The genetic algorithm, the most important part of the genetic algorithm is a fitness function, which is another word for loss function. We can maximize the return, or we can minimize the loss. Or another way, my approach will be maximizing the Sharpe ratio. So the Sharpe ratio is a return of a risk. So it is also considered the value for money. You want a minimum amount of risk, and you also want a maximum amount of the return. So There are some valuation metrics I will talk about. So it's first is the return definitely, and the Sharpe ratio, which we're maximizing, a maximum drawdown, and average position. Average position is important here because with genetic algorithm, it results in different weighting strategies. It does not invest all of the money or the same amount of money every time. It invests different amount of every time depending on the strength of the signal. So the average position means on average how much percentage of the entire capital is invested in the stock or invested in the market. So the other parts are actually safe money. So these are my experimental results. First, we can look at the results of the returns. All the returns are positive. They are pretty good, which indicates that the trading group can, to some extent, to predict the trend of the price. And the second thing is we also use random forest and SVM to predict to make the point-wise estimation and invest all of the money. If it's 1, and invest all of the money on short if it's -1. So for random forest, it achieves the best return. However, it is not considered the best model here because we also have to consider how much money is investing. Also the Sharpe ratio, how much risk is involved. So we can see on the genetic algorithm that maximizing the Sharpe ratio here, on average, it only invests about 1/3 of the capital while it achieves about 15% return. So if we adjust for the position times that by 3, we're going to get the same amount of Sharpe ratio, which is still the 10.571 Sharpe ratio, but with over 40% return. So it is considered a better model than the random forest. And it is also performing actually better than the genetic algorithm maximizing the returns because it achieved a better risk controlling aspect. So this is a graph of how the return increases over time. The blue line is the training data and the orange line is the testing data. We can see it's always going upwards. There's a strong upward trend with a little bit of bumps along the way, but that's actually fine. It's also worth mentioning that we're using only 1-to-1 leverage here, and the testing data achieved about 15% return in 9 months. Suppose we use like 1-to-50 leverage, we can get much higher returns, and it also maintains a very high return to risk ratio. So in conclusion, so we made some technical indicator rules, some trading rules based on technical indicators, and these technical indicators can capture some information about the trend, momentum, as well as the volatility. And the positive returns indicates that the returns are actually reflects that the technical rule, the trading rules are to some extent can predict the price trend. And the genetic algorithm optimizing the Sharpe ratio results can result in a low position and high return over the risk. Besides, it also achieves active portfolio management where you don't invest all of your money at the same time. So with only 30% of the capital invested, you can actually have the rest of your money investing other securities, such as like you can invest the other amount of money in pound dollar, you can invest in like the stock market. You can achieve some better results over this one. So the next one is a limitation. So the final limitation of this my trading system is that transaction fees are not actually considered in here. So that's a problem. We'll incorporate that in the future research over the summer. And also I can also we'll be working on the applying some complex model to predict the point-wise price movement, such as using neural networks and combine them with genetic algorithm. So in that sense, it can predict the price well as controlling the weights of the portfolio. So to reduce the amount of risk you're exposed to. That's the end of my presentation. Thank you for listening.
Thanks, Zach. So did you do any theoretical calculation of if we would have used like a margin of 50? So how much the profit would be?
50 leverage?
With the 50 leverage, yeah.
With my hypothesis and assumptions, if I'm using 50, the return will be times by 50.
Right. So 15% times 50.
That's 7.5 times 750% in 9 months.
So almost 1000%. That's great.
Yeah, that's crazy because that's the main problem here because the transaction fees are not involved.
Yeah,
and I'm using 5-minute data frame, so 5-minute time frame. So it's actually pretty high frequency.
And then the spread is not being considered as well.
Yeah, I haven't considered spread. So that's the main problem.
That's another problem because sometimes the spread is high, sometimes it's low.
Yep.
Any other question?
For you deciding the trading signals, how did you like decide like the time period, like what time you are putting like an order?
Okay, so it's like a moving average window size, the period size.
Okay, so like how many days or like minutes?
So I have included in my final report, I have optimized them according to if I'm using only one single route on the training data, how much return am I making? So I'm using a grid search method to search through a whole list of numbers. So I'll find the optimal parameter for this one. Okay. So there are all sorts of different parameters. So it took quite a lot of time.
Okay.
Thank you.
Any more questions? The model, does it always make money or does it lose money sometimes?
It doesn't lose money at all because there's no transaction fees. But I think with transaction fees, it might lose some money. But with this one, no transaction fees, it doesn't lose money.
Okay. So does the model like actually, if you're doing Forex trading, it's possible that the model like, starts at a point that's not really a buy signal, but should have been a sell signal, but it took a buy position. Does it recognize that error?
It doesn't actually recognize error, but that's a good question here. So I'll move back my slides here. So for this one, suppose we're taking a short position over there and the price is going down here. If we have a prediction model that works 100% accurate, we're going to stop the trade from there, right? Because it's going up for the next period. But for this one, it kind of ignores the short-term fluctuations. It will focus on the longer term of the trend, longer trend. So it's working in a different direction instead of focusing on the short prediction. Yeah. Thank you.
All right, thanks, Zach.
Thank you.